Hello everyone, I am Svetlana Sagrayan, and together with Anya Soyan, we are going to demonstrate an application of Dynare Julia that is already being used at the Central Bank of Armenia for shadow projections. This model is called Endocred. We will cover some materials to help you better understand how this model is solved, what the mixed complementarity problem is, and other related aspects. We didn't want to make this course very technical because we always like to say, never say, model says. It is not the model that gives us answers to the questions, but it is the economists who use models just as their tools. Our goal is also, as Doug likes to say, to create Bob Solos. We don't want to create models. We always say we would rather have Bob Solo rather than an econometric model, but we much prefer having a Bob Solo and an econometric model together rather than without one. Our model includes endogenous monetary policy credibility. This is probably the biggest difference from the models currently used at central banks. There are also other differences. We have endogenous monetary policy credibility, and another important feature is that we are not ignoring the non-linearities in the economy. We are not linearizing our model. Instead, we have a non-linear model here. It is a semi-structural model, not a DSG model, and it has several non-linearities in it. We use the algorithms of mixed complementarity problems to solve these kinds of models. In general, when we say a mixed complementarity problem, we mean models that can have these three characteristics. Instead of a linear reaction function or a linear policy rule, we have a loss minimization function for monetary policy, and this is a non-linear function, of course. This is the first ingredient of MCP. We also have other non-linearities, as I mentioned. One is endogenous policy credibility, and the other is the Convex Phillips curve. Another ingredient of MCP is the occasionally binding constraints. For example, the effective lower bound on interest rates. At the period when the interest rates are pretty high and far away from the lower bound, this is not going to be very useful. However, there are some extreme scenarios we are analyzing, like financial crisis, where this kind of scenario might also take place. We keep this property in the model for now. In the course that I will share with you, we will have the occasionally binding constraint.
Let's start with the first nonlinearity in the model, which is the monetary policy loss function. This is a pretty standard monetary policy loss function where the loss is equal to the squared deviation of inflation from its target plus the squared output gap. They have the same coefficient in front of them, 1.1 times the deviation of inflation from the target and 1 times the squared output gap. We also have a third component, which is the deviation of interest rate from its lag. This penalizes sharp increases in interest rates. The coefficient on this is not the same as for the other two. It is 0.5. There are different approaches between the reaction functions and loss functions. For example, in simulations from Alicia and others, 2015 IMF working paper titled Avoiding Dark Corners, a Robust Monetary Policy Framework for the United States. You can see the red line showing policy rates not adjusting much. This period from 2014 onwards saw advanced economies at the effective lower bound. Optimal policies suggested keeping rates low for longer, which led to a slight overshoot in inflation before returning to its target. The same applied to the output gap, which overshot slightly before stabilizing. This model, originally for the United States, has a working version adapted for Armenia. The Armenian model is an open economy model, while the U.S. model we are showing is a closed economy model. For the U.S., the loss function looks different because the Fed does not prioritize positive output gaps as much. When they adopted explicit average inflation targeting in 2020, their focus shifted to addressing negative unemployment more than positive unemployment. One of the key charts we present demonstrates the monetary policy transmission mechanisms. It illustrates how the policy rate path affects longer-term interest rates, exchange rates, inflation expectations, and ultimately inflation. We emphasize the policy rate path, not just the rate at a single moment. Policymakers consider the medium-run policy rate's effect on longer rates, current premiums, inflation expectations, aggregate demand, and inflation.
At the Central Bank of Armenia, the FPAS Mark II framework is now in use, transitioning from the previous FPAS Mark I framework, forecasting and policy analysis systems. The main difference in the new generation framework is that it will not rely on creating baseline scenarios to analyze and forecast the economy. Instead, it adopts a risk management approach to monetary policy. Policymakers will consider all potential risks, including extreme ones, and prepare tools to address these risks if they materialize. To create the FPAS Mark II framework, we have taken multiple steps, including transitioning from MATLAB, which is licensed software, to completely free software like Dynare Julia. This will be used for writing all models, including the main projection model and satellite models. Over the medium term, we plan to migrate everything from Iris and Dynare MATLAB to Dynare Julia. In the FPAS Mark II framework, there will not be just one baseline scenario. Instead, we will develop multiple scenarios. Together, we will create two scenarios today, a Hawkish scenario and a dovish scenario. These scenarios aim to answer three essential questions: where the economy is now, what is driving the economy, and how policy instruments should be adjusted to achieve objectives. These scenarios will help policymakers decide how to adjust policy tools and understand the implications of insufficient adjustments. Finally, Dynare Julia can be used to address all these questions effectively.
Now we can come back to our model equations. The next nonlinearity that we have, as I mentioned, is the Convex Phillips curve. We call it the inflation expectations augmented Phillips curve, because you can see the term here, inflation expectations. These expectations are not based on data, but are model-based inflation expectations. The nonlinear part is the one where you can see the lag of the output gap multiplied by the maximum value divided by the maximum value minus the rate. To look at it more visually, we have this picture here. You can find more information about how we think about these convex Phillips curves in our working paper. The paper is titled Getting Fit with Endogenous Monetary Policy Credibility, an application in Dynare Julia. It is a Central Bank of Armenia working paper. The nonlinearity we introduced is as follows. If you look at this cycled area, it is approximately the area between -2 and 2. Here, the Phillips curve is basically linear. However, as inflation gets higher and higher, we risk hyperinflation. We call this a dark corner. What happens is that if the output gap reaches the Ymax value, some maximum value that we introduced in the model equations, inflation starts increasing exponentially. The blue, red, and green lines represent the convex Phillips curve under different values of Ymax, such as 4, 5, and 6. There is a lot of literature supporting the hypothesis that the Phillips curve is not linear. Ignoring this nonlinearity is not very beneficial when analyzing the connection between the output gap, or unemployment gap, and inflation, as well as inflation expectations. Now, the other and last nonlinearity we have here, as I mentioned earlier, is endogenous monetary policy credibility. Credibility is not something that we can model easily. We need to think about concepts that will help us model central bank credibility and performance. In our case, we approach these concepts in terms of underlying inflation. We create two inflation regimes, low inflation and high inflation. L represents the low inflation regime, and H represents the high inflation regime. In the low inflation regime, inflation is close to the target and converges to it. In the high inflation regime, inflation is closer to higher values. For the U.S., as an approximation of high inflation, we use the number 10%. Based on these two regimes, we have the following equations. The first equation represents inflation in the low regime, and the second represents inflation in the high regime. In the low regime, inflation is equal to a coefficient multiplied by the lag of inflation plus 1 minus the coefficient multiplied by the target. In the high inflation regime, instead of the target in the second part of the equation, we use the high value. This demonstrates whether current inflation is closer to the target or closer to the high value. For example, in the case of the US between May 2021 and 2022, inflation increased significantly and was close to 10% for a couple of years. This situation indicates a high inflation regime, which caused the central bank to lose some of its credibility. Our objective is to get a numerical estimate of this credibility and how much was lost. We will introduce this estimate into the model as an initial condition. One question arises: which inflation measure do we use here? Is it core PCE or sticky price inflation? In this model, we use core PCE inflation. However, the central bank credibility measure is based on sticky price inflation. To think about this credibility measure, we introduced a new concept called the Central Bank Performance Indicator, denoted as ETA. ETA is equal to the square difference between inflation in the high regime and current inflation divided by the squared difference between high regime inflation and low regime inflation. This creates a number between 0 and 1, where 1 represents the low inflation case and 0 represents the high inflation case. When inflation is consistently high and close to the high value, the central bank's credibility approaches 0. However, we do not consider credibility as a single period phenomenon. Instead, we treat it as a stock that builds over time. This is why we model it as an autoregressive AR process. The central bank performance indicator in the current period is equal to the lag of the indicator multiplied by a coefficient 0.1 plus 1, 0.1, which is 0.9, multiplied by the lag of credibility. This means credibility builds upon its previous value over time. Credibility connects to the rest of the model through the inflation expectations channel. Inflation expectations are equal to credibility as a coefficient on the forward-looking part of inflation expectations plus 1 minus credibility multiplied by the backward-looking part. B represents an expectation bias, calculated as 0.1 times 1 credibility. Because the performance indicator is a number between 0 and 1, the same applies to central bank credibility, which is also a number between 0 and 1. Let me show you how we estimated it for the United States. As I mentioned, it is based on 2 papers. The first one introduces the imperfect policy credibility closed economy model, and the second is the open economy version being implemented in the shadow projection. Both are implemented in Dynare Julia. These are based on the sticky price inflation indicator. For the United States, we have the advantage of having a database for the sticky price inflation indicator. This measure is not only useful for analyzing central bank performance or credibility, but also for many other aspects of economic analysis. We use this measure extensively in our work and analysis. Creating a similar indicator for other countries is not very difficult. We have already implemented the methodology used for the US in other countries and have developed additional methodologies for different contexts. For all your countries, it will be straightforward to create an indicator like this based on CPI inflation data or PCE inflation data. It is a very straightforward process to create a sticky price inflation measure.
We consider this measure valuable because it captures prices that are not adjusted very often. Economic agents only adjust sticky prices when they change their long-term inflation expectations. For example, it is easy to think of sticky prices in terms of haircut prices. How often do hairdressers change their prices? The answer is not very often, except in cases of highly elevated inflation environments like those experienced in recent years. During such periods, we may notice changes in haircut prices. These measures provide insights into the underlying price-setting behavior across the economy and help central bankers and policymakers understand inflation expectations. This measure is based on the Atlanta Fed's sticky price inflation indicator. In our chart, we color-coded the data to make it more informative. For example, the period highlighted in blue represents the late 1970s and early 1980s. This was the era of Volcker's inflation when the Fed chair Paul Volcker raised policy rates to double digits, close to 20%, to combat extremely high inflation. During this time, the Fed lost its credibility because it had been in a high inflation regime for a prolonged period. According to this model, the Fed's credibility was very low during this time and only began to recover after decisive policy actions brought inflation back to target levels. Inflation expectations also started to decline. However, the Fed's credibility within the framework of this model did not immediately return to perfect credibility. This makes sense because the 1980s crisis was followed by another period of instability in the 1990s. Inflation during that time was not well anchored to, for example, 2%. It was only after the 1990s, when inflation began to decline and stabilize around 2%, that the Fed's credibility started to increase. For a long time after the tenure of Volcker and Greenspan, long-term inflation expectations gradually became anchored at very low levels, close to 2%. Although 2% was not officially the Fed's target until more recently, it aligns with the idea of a low inflation regime in this context. For a long time, inflation and inflation expectations remained anchored at these low levels. It was only after the COVID crisis and the associated economic shocks that inflation in the US surged to almost 10%. In 2021, the Fed did not take immediate action to bring inflation back to target levels. As a result, credibility losses began to accumulate. At the end of this chart, we see a slight drop in central bank credibility. This drop is not dramatic. It reflects a decline from 1 to approximately 0.95. However, this small decrease will serve as the initial condition for our model to make the case that the Fed currently does not have perfect credibility. If we compare scenarios in which a central bank has perfect credibility to those where it does not, we see significant differences. In the case of imperfect credibility, the central bank must adjust its policy instruments more aggressively than it would otherwise. This increased effort is necessary to bring inflation and inflation expectations back to the target.
I want to mention that the output gap is the percentage of potential output. It is calculated as output minus potential output divided by potential output. When the output gap is 5%, it is actually a very big number. There has not been a recent period in the United States where there was an estimated 5% output gap. However, some empirical work, such as a paper from the 1990s written by Doug and the current governor of the Bank of Canada, examines this issue. They claim that a good measure of the maximum output gap for advanced economies is 5%. This is the maximum level of the output gap estimated for the US. Yes, we can think about it that way. If we reach that capacity, meaning we have excessive demand at 5%, inflation increases exponentially. For Armenia, the situation is different. For a developing economy like Armenia, the number can be higher. I think for Armenia it is something like 7 or 8%. The standard output gap equation used in most central banks and quarterly projection models. The only difference might be the inclusion of the deviation of real interest rates from their equilibrium. This is standard in our models, along with the deviation of the term premium from its steady state. When working with this model, we need to consider these measures, such as equilibrium real interest rates and the term premium. To think about these, we can look at the Fed's dot plots and estimates of the term premium. These estimates are available on the New York Fed's website. For example, we are conducting separate research showing that current real interest rates are not as low as they appear in the Fed's dot plots. They are slightly higher. I will show our initial conditions and steady state assumptions when I demonstrate the code. In the FPAS Mark II framework, we no longer use the concept of a baseline. We believe it is unrealistic for a policymaker or central bank to create a single scenario that accounts for all assumptions and risks. As Lawrence Summers calls it, relying on baselines is a folly. In FPAS Mark II, we eliminate this folly by avoiding baselines and local approximations. Instead, we build multiple scenarios to reflect the risks policymakers perceive and prepare tools for when those risks materialize. Another important aspect is avoiding the folly of local approximations. We retain non-linearities in the model, which is crucial. Dynare Julia provides the necessary tools and algorithms to solve nonlinear models. This capability is particularly beneficial because it allows us to work efficiently even with limited resources and time. In the shadow projection, for example, we are a small team with tight deadlines. Using Dynare Julia and our EndoCred model, we can build scenarios and complete the Not the Teal book in as little as 3 days or up to a week. This includes scenarios, policy analysis, and the final documentation. When working with Dynare Julia, you will see how fast it is compared to MATLAB. Julia runs much faster in many cases, saving significant time. Regarding risk management scenarios, we label them as Scenario A, Scenario B, or Case A, Case B, Case X, Case Y. Case A scenarios are hawkish, with policy rates higher than the reference policy path or market expectations. Case B scenarios are dovish, with policy rates lower or staying below the reference path. The reference policy paths are the expected future paths of policy rates for advanced economies. In the United States, such data is readily available. For smaller countries like Armenia or Georgia, this data is not easily accessible. We are currently working on methodologies to create comparable measures for these countries, which will serve as reference points. The scenarios we simulate are based on the latest FOMC decisions. For example, in January, inflation numbers suggested that the high inflation period might be over. People believed the Fed had inflation under control, expecting policy rates to peak around 5% before gradually declining. However, by February, new data showed higher inflation and a strong job market, raising concerns that policy rates might still need to increase. By March, the banking crisis shifted expectations dramatically. Market participants feared the Fed would prioritize financial stability over inflation control, leading to expectations of lower interest rates. Within 1 month, expectations for peak policy rates dropped from 5.15 to 4.50%. In Case A scenarios, policymakers increase rates higher than the reference path, while in Case B scenarios, rates stay below the reference path. One is hawkish and the other is dovish. This is a chronology of the events surrounding the banking crisis that started in March. The first event was the failure of Silicon Valley Bank on March 10th. Shortly after, on March 12th, Signature Bank failed. On the same day, the FDIC invoked the systemic risk exception. They assured everyone that all deposits, even those exceeding the insured amount of $215,000, would be returned. This action was taken to reassure depositors and calm economic agents. Policymakers tried their best to address the situation and prevent a larger banking crisis. However, more bad news followed. On March 15th, Credit Suisse's shares dropped by 24%. 4 days later, UBS acquired Credit Suisse in Switzerland, and in the U.S., First Republic Bank lost 1/3 of its value. Given these events, markets reacted differently. Some market participants expected the Fed to hold rates steady, while others anticipated rate hikes. Ultimately, the Fed decided to increase policy rates, but their communication strategy shifted. They announced that they would tighten policy only if necessary. This statement left uncertainty about whether rates would rise during the next policy decision. The Fed emphasized that future decisions would depend on how the banking crisis affects the U.S. economy. Another key point mentioned by the Fed chair was that banks were tightening credit conditions. This tightening acts as a form of policy tightening since economic agents now face stricter conditions for obtaining loans. These stricter conditions suppress aggregate demand, effectively simulating the effects of a rate hike. This dynamic is why one extension of our EndoCred model will incorporate bank lending tightening measures. We are currently developing a new version of the model to include this feature. Incorporating these measures allows us to model financial crises or milder banking crises. For example, during the 2008 financial crisis, commercial and industrial loan standards tightened by nearly 80%. This metric is a strong indicator of financial crises. By including such measures in our modeling framework, we can simulate financial crises or other scenarios like banking crises. These simulations help us understand periods when the economy approaches the effective lower bound again. These simulations are generated in Dynare Julia, and you will see the same outputs. In the Case A scenario, the economy continues to run hot. This simulation, based on March data, assumes that the real growth of the economy remains above potential. Strong consumer demand primarily drives this growth. At the same time, underlying inflationary pressures persist, and labor market data remains strong despite expectations of weakening. In this scenario, policymakers need to increase rates above market expectations, with the peak around 6.2%. Rates would need to stay elevated for some time to bring inflation back to target and close the positive output gap. For the U.S., the inflation measure used is core PCE, with the Fed's target set at 2%. Other model variables include the 10-year term premium, the central bank credibility index, real GDP growth, real interest rates, unemployment rates, and 10-year government bond yields. Central bank credibility in this scenario does not fully recover during the 5-year horizon because it is modeled as a stock that builds slowly over time. With a large coefficient on the lag, 0.9, and a small coefficient on performance indicators, it reflects the challenge of rebuilding lost credibility. This parameter can be adjusted for other countries based on historical data. In the case B scenario, the measures already taken are assumed to be sufficient to cool the economy. In this case, no additional rate increases are needed to achieve policy objectives. Interest rates start decreasing almost immediately, inflation declines, and the economy experiences a negative output gap and low GDP growth for the next period. The banking crisis and tighter lending conditions have a negative effect on the economy, contributing to this outcome. However, in this scenario, central bank credibility recovers faster than in case A. Unemployment does not increase significantly, and real interest rates remain close to zero, though not negative. If we were to simulate risk scenarios involving a banking or financial crisis, we might consider negative real rates. This concludes the presentation part of our discussion. Next, we will move on to the technical section and simulate the models in Dynare Julia.